Well, hello, welcome, glad you could join us. My name is Brett Hersh. I'm an instructor for Overnight Accountant. I'm also the owner of Real Estate Tax Pros. And just announcing, I am also the author of the Real Estate Agent Tax Cut Library for 2022. You got one for 2023, but right now it covers 2022. Check it out. We'll put a link here. It's published by Overnight Accountant. We'll hope it's designed to be easy to read for the regular person. I'm trying to get away from all that technical stuff. So it's really a hands-on library that you can use to cut your taxes if you're self-employed real estate agent. So check it out. All right, briefly, I'm going to discuss a couple items with regard to long-term rentals. How it applies to your taxes, particularly what we're going to talk about. Before I do that, disclaimer, pause it, read it. Topics. We're going to talk about business structure. Okay, what's your business structure have to do and how is it treated for tax purposes? Go over just real brief, it probably wouldn't be 5 minutes, but we're going to talk about depreciation because that's a big problem area for people, particularly those who are doing their own taxes that have long-term rentals. You got to depreciate it, which we'll discuss again. And then we're going to have question time, which basically means, guess what? You want to post a question? Post a question as a comment. We'll get back to you hopefully fairly soon. So let's roll on. Okay, rental structure. You basically got a sole owner, you got a partnership, you got an LLC, you got an S Corp, and that's pretty much it. You could do a C Corp, but this is what we mainly see with individuals that are, you own 4 or 5 properties, you own 1 property. This is the business structure we commonly see. So let's go over what a sole owner is. Basically, as it says, you're a single individual who owns the rental. Now what you do then is you're going to report your income or loss on Schedule E, that is income or loss from rental real estate or royalties. Now the income loss, if deductible, that's a very big thing. If it's deductible, there are very serious limits onto that, flows through to Schedule 1 and then page 1 of your Form 1040. Now let's talk about partnership. Now this is where these are easy to do, but they're hard to get out of. So let's talk about it. Anytime 2 or more individuals own the rental, and it's in that partnership name, or they each own it, and they're renting it out, guess what? You are a partnership. That's a separate form. You got to file Form 1065. That's a return for a partnership income, which means you're probably going to need to hire somebody to do it because you don't want to be doing a partnership return on your own. I'll tell you why in a minute. Now, however, if you're a married couple, you can form what's called a qualified joint venture. You don't really form it, you just kind of treat it like that. And that basically means you don't have to be a partnership return. You can each file a separate Schedule E and kind of break it down in half. That's basically how it works on your personal return. But you have to be married to do it, and if you form an LLC, guess what? No more. You're a partnership. Okay, let's move forward here. You can report your rental. It goes on until technically here, Form 8825 on the Form 1065. Now, in a partnership, you receive what's called a K-1 each year from the partnership. That's where you report your share of the income expenses, or the partnership reports it to you, and then you file your tax return. It ends up on Schedule E and it flows through from there. Income or loss, though, is treated as though you own the property. So it's basically how much you participate in the rental and that sort of thing controls your loss on your personal return. Let's not get into too much here. Here's the issue with rentals. I mean, I'm not rentals, but partnerships owning rentals or any business. They're very easy to form, highly complex. Believe it or not, they're the easiest to form, and they're one of the most complex tax structures there can be. And what you got to be careful of when you form these, especially you got real estate in a partnership, right? You get real estate in that thing. What if you guys don't like each other in a year or two? What if you're doing all the work, they're not doing any work? What happens? This is more legal land, not taxville, but I just want to make you aware, have a solid partnership agreement up front. I'm not an attorney. Specify the duties, though. In this agreement that you go to have an attorney draft up, make sure you specify the duties of each partner, what's expected of them, how you can bring in new partners, and how someone can leave. You got all your income tied up in a rental property, a rental. How are you going to pay them if they decide to leave or they want out? Think about it in advance before things fall apart. Remember that. All right, LLC. See this a lot. See this a lot with rental companies. Or rental ownership. You put the property in an LLC. Now what I got to tell you is about that, it's a state-created entity. It separates members for legal purposes. I live in Taxville, not legal land. Talk to an attorney, but it separates the members from the business property, primarily for liability reasons, limited liability. So it limits liability. As I said, that's attorney land. As far as your taxes, IRS ignores them. They are what's called a disregarded entity. They do not impact your taxes. One question received, what if I form an LLC? How does that impact my taxes? It really doesn't impact your taxes. It's disregarded. IRS ignores them. Okay, does not impact your taxes. If you're a one member, you're treated like a sole owner. For Schedule E 1040, you got 2 or more members in your LLC. Now your partnership Form 1065. Now an LLC, once you form an LLC, at some point you might want to elect to be an S Corp. We're going to talk about that warning here in a second, but it is possible. So, S Corps own real estate. You see this? You see that? You see that right there? Pay attention. All right, small business corporation, you can have up to 100 shareholders. An S Corp, LLC, you can elect to be treated. If you're C Corp, you can elect to be treated. There's a form you fill out, you send it in. It's not hard to do. It's an entity separate from the owners, like an LLC, according to the IRS. Okay. Owners who provide services. If you're providing services, material services to that LLC, even though it's a rental, you should be on payroll. Okay, that's one of the downsides of these things. You've got to be on payroll and pay yourself a reasonable salary if you're providing services and not a passive investor. Now, owners receive a K-1 similar to a partnership, and then it all goes, it all flows over to your personal return. Here's the issue with S Corps. Okay, real estate, if you have an LLC or a partnership or sole owner, you can pull, well, LLCs are treated, you can pull the real estate out at your cost basis. We'll discuss that a little bit more. Okay, you can pull that property out. You want to live in it personally. You want to give it to your daughter. You want to give it to your son. Whatever you want to do, you can pull that out at basis. Okay, in an S Corp, when you do that, that is called a deemed sale. It's like you sold the property at fair market value. Also, if you pass away and someone inherits your S Corp, they inherit the shares. The shares are what gets a step-up basis, not the underlying property in the S Corp. Okay? Okay. Here's example 1. I'm ignoring depreciation here. I know it exists, but we are ignoring it. Okay, let's say Sarah buys a rental for $100,000 in 2012. Okay, she buys it. She's the only one in living in it. It's not an LLC. It's not an S Corp. Okay, maybe she has an LLC. Maybe she doesn't, but it's not an S Corp. In 2020, it's worth $200,000, and she decides to move into the rental as her primary residence. She moves into the rental. It does not create a taxable event. She moves in there. The basis of her home is $100,000. Okay, I can get in if she lives there 2 out of 5 years and all that kind of stuff, but just keep that in mind. The basis of her home is $100,000 because that's what she bought it for, and ignoring depreciation. That's example 2. Let's say Sarah's S Corp. Oh, I want to go back to LLCs. If you get an LLC, you've got to title it, deed it in the LLC name. You can't buy it first anyways, that's an LLC thing. I should have mentioned it earlier, but it's too late now. All right, Sarah's S Corp buys the rental for $100,000 in 2012. Exact same facts and circumstances. 2020, it's worth $200,000. I'm ignoring depreciation. And she decides to move into the rental as her primary residence. Guess what? That S Corp that she owns just sold that rental for $200,000. Sarah is going to owe tax, capital gain income, ignoring depreciation, probably more than that because it's what's called recapture, which I'm not discussing here. Not yet. So she's going to owe taxes on a $100,000 capital gain, and she took what she thought was her property. Okay, same what happened if Sarah's S Corp transferred the home to her daughter. Same deal. She just sold it. Okay, the S Corp owns it. She does not own it. She owns the shares. An inherited S Corp can create a similar mess. There's ways to get out of it. It's a little complicated, and actually you need a little flow chart for it, which kind of makes me nervous. But that's what's going on with that. Okay, real quick, depreciation. This is where we see, okay, it's not an option. We see this all the time with people, primarily when you're doing your own taxes. You don't understand depreciation. If you're preparing your own return, you have a rental. Depreciate is not an option. You have to depreciate it. If you don't, the IRS will do what it calls deemed depreciation. You didn't get the tax benefit from it, but guess what? You owe taxes on it if you sell it. It's depreciated. Okay, we'll go over that in a little more in a minute. All right, land, however, is not depreciated. So if you have a townhouse, let's say it's almost all building, but I used to take a little postage stamp of land, put the value to it. If you have a house on an acre, that acre of ground when you purchased it, that acre, the fair market value of that acre, well, whatever you paid for it, your cost basis, when you purchased it, that is not deductible, but the building is. It's kind of weird. It's how it works. Okay, now if you haven't claimed depreciation, we can fix it, or go to a professional. They can fix it. It's a certain thing you can do. It's it's accounting change basically. It's pretty complex, but you can do it and claim the depreciation in 1 year. That's just know that you can do it. Okay. Now depreciation also follows the income. It follows the owner in the home itself. So it's kind of tied there. You pull it out. If you pull it out, use it for business use, that depreciation is still. Use it for personal use. I'm getting ahead of myself. It has depreciation in that rental, but you live in it. Even if you live in it for over 2 years as your primary resident, that depreciation is still there. So you can pay taxes on that. It can create recapture upon sale. And we're going to discuss that real quick here in an example. Let's say I purchase a residential rental for $200,000 and the land's worth $50,000. All right, that means I got $150,000 in the building that I'm depreciating over 27.5 years. And I had it for 10 years, and that means I've got depreciation of $45.55 per year, so that's $54,550 in depreciation. All right, let's say I then sell the rental for $300,000. My basis, which means my remaining investment, I know I'm going faster, you can slow it down or watch it again. That's $200,000 minus the $54,550 depreciation. That means my basis in the investment. Remember, I paid $200,000 for it, land's $50,000. $150 to the building. I got a remaining basis of $145,450. I sold it for $300,000. That means I have a gain of it's $300,000 minus my basis, $145,450. That means I have a $154,000 gain. This is where recapture comes in. That depreciation I claim, that's taxed at a higher rate, up to 25%. The remaining $100,000, which is kind of cool, that worked out to be $100. That was completely accidental. Just by the way. That's taxed at a capital gain at 15%. Okay, there you go. That was real quick, real sweet. Questions? Post them. Check out our book, The Real Estate Agent Tax Cut Library. Check out overnightaccountant.com. Look for classes. We're here to teach you and help you with your tax stuff and your business stuff.